Heya Cryptozens, welcome back to the Crypto Overnighter. My name is Nikodemus and we do crypto news analysis nightly at 10 p.m. And keep in mind, none of this should be considered financial advice. And it's Monday, February 20th, 2023. And I hope your week is off to an excellent start. Now, let's take a look at what's going on in the world. Klaus Knott is the chair of the Financial Stability Board, the FSB. And he said that numerous stablecoins are currently available right now that might not comply with upcoming global standards. Those standards are considered high level and will be established by organizations such as the FSB. Which, okay, great. So who's the Financial Stability Board to be making these decisions? The FSB was established in April of 2009 as the successor to the Financial Stability Forum. It was at the Pittsburgh summit that the heads of state and the governments of the G20 endorsed the FSB's original charter. So, G20 is the genesis of the board. Now, the board would tell you that they're trying to maintain worldwide financial stability by coordinating the creation of regulatory, supervisory, and other policies in the financial sector. To achieve this, the FSB follows a three-stage process. The process focuses on cooperation, consistency among its members, and also involves outreach to non-member nations. Knott wrote a letter to the G20 finance ministers and the central bank governors regarding the FSB's upcoming guidance. This guidance will aim to enhance stablecoin governance frameworks, redemption rights, and stabilization mechanisms. The FSB released its work plan for 2023. This includes finalizing recommendations for regulating crypto and stablecoins by July. Regulators worldwide have been regulating payments-focused stablecoins. These stablecoins are usually backed by fiat currency reserves in the form of cash equivalents or unsecured short-term debt. Stablecoin issuers have tried to remove private debt from the reserves to increase transparency. Tether, for example, has done a lot of work to get rid of their corporate paper. However, Klaus Knott's statement suggests that these measures may not be enough. Knott stated in his letter that numerous stablecoins would not conform to the international standards established by payments or securities standard setters. The Financial Stability Board cautioned in February of 2022 that corporate risks could pose a threat to financial stability. This follows the failure of several companies last year, like Terra and FTX. Regulators, including the FSB, have been stepping up their oversight of the crypto sector, and we can see the effects of this in how they're trying to choke the fiat out of crypto. The Financial Stability Board recently announced that it will collaborate with other standard-setting bodies to determine how to regulate decentralized finance, so be scared of that. Additionally, it is working with the International Monetary Fund to create a paper on regulatory matters linked to cryptocurrency. FTX Japan announced on Monday that it will resume withdrawal services for fiat and crypto assets. This service will start at noon local time on February 21st. This makes good on a December promise to restart withdrawals. The exchange's assets in Japan were mostly limited under local law. The company said that it may take a while to complete the withdrawals due to many customer requests. FTX Japan closed on November 8th. Shortly before FTX filed for bankruptcy in the United States. FTX Japan and FTX Europe are expected to be sold early to recover money. The Securities and Futures Commission in Hong Kong made a proposal on virtual asset trading platforms, and they're asking for feedback from the public. This plan includes creating a licensing system for crypto service providers. The regulator is also asking for opinions on licensed platforms serving retail investors. They want to know what investor protection measures should be in place. This new regime requires all crypto trading platforms to prepare for the new rules. This includes existing platforms that want a license. So those who don't plan on getting licensed will be forced to shut their doors, at least in Hong Kong. The regulation of stablecoins in Hong Kong is set to begin in June of this year. On Monday, a consultation paper proposed new requirements for crypto trading platforms. These include assessing client risk profiles and setting exposure limits. operators will need to conduct due diligence on tokens and monitor them. This involves checking the regulatory status of the asset in each jurisdiction where the operator provides trading services. This paper also proposes checking the operator's liquidity and ensuring holdings aren't controlled by a small number of people. Crypto trading platforms can only offer tokens that meet the Commission's criteria for eligible large-cap virtual assets listed on 2 acceptable indices. The operators must conduct smart contract audits on tokens to identify security flaws. The proposed measures prohibit operators from offering virtual assets that meet the definition of securities. Doing so would breach Hong Kong's Securities and Futures Ordinance. Operators must provide a compensation arrangement approved by the SFC to cover risks. They're going to require this instead of setting a hard limit for assets to be held in cold storage. They need to monitor the amount of customer assets held daily and adjust the arrangement accordingly. Licensed operators may need to establish a token admission and review committee to assess tokens for trading. The committee will set obligations for issuers to inform operators about any hard forks, airdrops, or regulatory action. The SFC acknowledges the industry's desire to offer derivatives and is open to hearing about business models and demand. They plan to conduct a separate review to draft related policies. In January of 2022, the SFC allowed retail investors to access some regulated crypto-related derivative products traded on conventional exchanges. The SFC initially seemed hesitant to allow retail investors to access crypto under its virtual asset licensing regime. The regulator signaled a change in its stance at the Hong Kong FinTech Week in November of 2021. The consultation period for the new licensing regime is open until March 31st, and then it will take effect on June 1st. Crypto traders have a positive outlook on Hong Kong due to the changes in the city's licensing rules. The government aims to position Hong Kong as a financial center for digital assets. Recently, the city's central bank issued the world's first tokenized green bond. This raised approximately $100 million for green energy technology and related projects. Hong Kong announced new mandatory licensing provisions for centralized crypto service providers last year, effective June 1st. The SFC aims to find a balance between investor protection and market development. The regulator proposed limiting retail traders' access to only the largest tokens. The consultation paper outlines that eligible large-cap virtual assets must meet market-specific criteria issued by at least 2 independent index providers. The regulator has requested that the exchanges provide an explanation of the crypto derivative products that they want to offer investors and why. Currently, licensed exchanges in the city cannot sell crypto derivatives, although the regulator is considering changing that rule. Taiwan's Ministry of Justice and the Independent Commission Against Corruption, or ICAC, are considering adding cryptocurrencies to property declaration laws for government officials. This is due to the growing use of cryptocurrency in illegal activities like money laundering. So that means Taiwan's Ministry of Justice may require public officials to disclose their cryptocurrencies, specifically due to their use in illegal activities. The ministry has also added crypto exchanges to the scope of money laundering prevention. The Ministry of Justice and the ICAC believe cryptocurrencies are not widely used for payments or accepted by financial institutions in Taiwan. Despite this, the ministry may still seek public officials and make them declare their cryptocurrencies due to their significant value. Now, this could be added to the Public Official Property Declaration Act. The ICAC noted that Taiwan's Corruption Perceptions Index score was 68 points in 2021. That put it in 25th place globally. That score surpasses 86% of the countries. And so it appears that Taiwan's anti-corruption efforts are getting worldwide recognition. The country has made significant progress in fighting corruption. Now, Chinese police arrested a group last year for allegedly laundering $5.6 billion worth of cryptocurrency. Taiwan is still interested in developing its digital innovation and launched a new ministry focused on information security and Web3 last year. The FTX scandal by Sam Bankman-Fried keeps revealing more consequences. Now, recently, BlockFi asked the United States Bankruptcy Court to remove Chapter 11 bankruptcy protections from SBF's offshore investment vehicle in Wilmington, Delaware. The FTX founder used Emergent Fidelity Technologies Limited to buy a 7.6% stake in Robinhood. BlockFi said that Emergent Fidelity's bankruptcy filing serves no real purpose except to prevent BlockFi from claiming shares of Robinhood. Emergent's liquidator, Quantumia, claimed that the bankruptcy filing was necessary to protect the rights of creditors. Tony Shulka is a director at Quantumia, and she said that many parties claim to be creditors or outright owners of Emergent's assets in various U.S. lawsuits. Quantumia believes that Chapter 11 protection is necessary to empower Emergent to defend itself, its assets, and its creditors' interests in the U.S. Shulka clarified in an affidavit that Emergent has no significant assets except the shares and $20.7 million in seized cash. She said that BlockFi's claim that the bankruptcy filing was motivated by fees is baseless. Robinhood commented that it wants to buy back the shares, but it's not sure that it can actually do so. In November of 2022, BlockFi filed for Chapter 11 bankruptcy due to the FTX collapse. In December, FTX asked the bankruptcy judge to prevent BlockFi from claiming $450 million worth of Robinhood shares purchased by SBF. The judge considered transferring the Robinhood shares claimed by both parties to a neutral broker or an escrow account while the rightful owner is determined. Now, kind of in that same vein, the FTX group tried to take money back from Voyager that Alameda had already repaid. Voyager's lawyers responded with legal requests. FTX claimed Voyager did not do their due diligence before giving Alameda money. This suggests Voyager was at fault, and FTX believes that it does not have to repay the loan. Voyager's lawyers, Kirkland and Ellis, filed subpoenas for information on various topics. These included FTX's low buyout offer. Ramnik Arora is FTX's head of product. They also received a subpoena. Now, this was unexpected because he had not been involved in court proceedings before. More subpoenas were served against FTX. Voyager Digital's Unsecured Creditors Committee filed subpoenas against FTX on February 18th. This list included Samuel Trabucco, the former CEO of Alameda. Now, Trabucco retired in August of 2022 and became a company advisor. Kirkland and Ellis served these subpoenas on behalf of Voyager creditors. This second batch of subpoenas focuses on FTX's buyout attempt of Voyager after its bankruptcy. Now, Voyager claims the buyout was not reasonable and was only done for publicity purposes. Voyager called it a lowball bid dressed up as a white knight rescue. Now, there was a proposal that was put forward that would see FTX acting as the liquidator. And so Voyager believes that the buyout was designed for FTX to get publicity instead of generating value for Voyager's customers. Now, Binance US won the bidding for Voyager Digital's remaining assets. Voyager customers will get 51% of their funds if this deal is successful. Depositions will be served remotely via Zoom starting on February 27th for as long as needed. Crypto scammers made less money in 2022. Their revenue dropped almost 50%, according to Chainalysis. Chainalysis suggests that this decrease in revenue might be connected to the drop in cryptocurrency values, because that's going to affect most of the scam types that rely on Bitcoin prices. At the start of 2022, crypto scam revenue was increasing, but in May it began to drop due to the bear market caused by the Terra ecosystem collapse. By the end of the year, revenue had fallen from $10.9 billion in 2021 to $5.9 billion. Now, victims were hesitant to spend their money as Bitcoin's value decreased, and that affected several types of heists that rely on cryptocurrency's price movement. In 2022, investment scams were the most common type, despite the decrease in revenue, because they still generated the most money. Romance scams had a different pattern of revenue, and although they had lower overall revenue as a category, they didn't experience a decline. Romance scams involve creating an emotional connection with the victim and then asking for help. They had the worst revenue per victim record. On average, victims deposited around $16,000, which was 3 times higher than the next category. According to Chainalysis, investment scams offer outsized returns and often used algorithmic trading strategies to lure victims. These scams are more successful when asset prices are increasing and there are stories of people striking it rich. Chainalysis discovered that many scams were controlled by the same group of people. The study found that many scams received money from other illicit addresses, indicating a connection between them. More than 200 fraudulent websites shared the same information about certain Commodity Future Trading Commission sanctioned entities. And that's going to do it for us tonight. I want to thank you, my listener, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, and subscribe. Leave a rating or a review. And in the meantime, we'll see you tomorrow night.